Hey everyone, so I'm recording a little bit early. Today's the 19th of November because I'll be going to the eToro PI conference soon. So leaving Australia, my home, so I'm leaving the studio, or what this is, my workstation or studio, whatever you want to call it. And I won't have all my equipment, so I decided to do this a little bit early. So yeah, I'm just going to do a quick investor update call. It's going to be faster than usual, I think. And yeah, let's get into it. So as doing the usual call, and as you all know, this is not financial advice, etc., etc., etc. Do your own research, and of course, you all know about me. This is my investment background and things that I do. I won't go through it. You guys can refer to my previous calls and all this. Yeah. So summary of where we are today. It's been an interesting ride, right? Like, when we did this update like 2 months ago, we were doing okay, right? So and portfolio has done slightly better, so it's a plus 3%. But I put this meme here, or this image, because number one, I've been watching a lot of Jujutsu Kaisen. Secondly, it's kind of interesting because I don't really attribute like a single trade or a bunch of trades to this. It's really just market volatility to me, and we're still up like 2.99%. But what was interesting is that the rest of the market fell. Like, so, you see here the S&P is down 6%, Nasdaq's down like the Nasdaq's down as well. So they're all down, but we managed to stay afloat. And again, this I think it's really just market volatility and just our bets kind of playing off. Of course, BTC has been huge in our portfolio, and that definitely helped. But yeah, I think it's been interesting. I'm going to remove this stat, by the way, once we come to the new year, because I don't see a point in kind of comparing myself to other eToro PIs. It's just not that interesting to me. Honestly, I'd rather watch paint dry. But yeah, so yeah, we'll see how we go next quarter. I'm going to give in a few reasons why I think we'll do well, but yeah, we'll start from there. So every quarterly call, I do one of these, which is, what's the thought of the call? And this week, this quarter, I just want to focus on, the importance of not having gigantic drawdowns. It's simple math, really, but I think it's something that's really important that some people copying me need to understand. And this is the reality of the way that we trade. We try and minimize drawdowns. Especially for the style that I do, I will always underperform in bull markets and overperform in bear markets. So I've been doing really well the last 24 months-ish. But again, that's really because, I tend to do better in bear markets than bull markets. So if there comes a bull market next year, I might not do as well. And that's on intention because we really want to minimize drawdowns as much as possible. So I won't take the riskiest positions. And I think that comes with benefits, especially over a very long period of time. So if you think about simple math, right? If you have a 50% drawdown, that is if you lose 50% of your money and you start with $100, you only have $50 at the end of year one. And in order to make back your $50, you would have to make 100% in year two. And that's very, very difficult. So one of the benefits, or one of the things that I think I came out really well last year, is I had only a minus 11% or 12% drop last year, and to break even, I needed about 13. So we got about 20-ish. I think we're about 20, about 23 right now. So we did pretty damn well, given all the market consequences and all that. Whereas if you copied the index, you would still be down. So I do believe it's one of the benefits of copying me, and it's the reason why I do eToro in the first place. I really am passionate about helping regular people invest. There's so much mental capacity wasted for the individual investor. Like, how do I invest my money, right? And it's very hard to trust anybody. So my job is to create this really long track record to show people, I can manage money in a decent enough way that you can trust me. And I put in my own money as well. So it's something I'm really passionate about, and this is why I do eToro. But I just wanted to talk about the importance of drawdowns because, I've seen some comments on my page recently, and I just wanted to clear that up. Okay, so market commentary. I think this will, again, be really short. Where do I see the market going between 2023 and 2024? Again, this is the usual answer I always give. I don't know, and I don't care. I put this as one of my thumbnails, one of the calls, but it's interesting. So However, I will say a few things. One is I do think there could be a potential recession coming up. Reason being is I think that the market is just severely underpriced the possibility of a recession. And there's some economic indicators that I'm looking at that do seem to indicate that tough times may be ahead. One of them is this is the unemployment rate. You can see it's slightly ticking up. It's still not significant, 3.6, but it is higher than a good long while back. Yeah, so unemployment is a major contributor to recession, so it could be a risk. Another is economic sentiment. Again, this is how people feel about the market, and if they feel good, they spend more. Most people don't feel very good in the US, so that's kind of why it's dipping this like low, and you can see it's lower than quite a bit, right? It's lower than COVID, I believe. So it's pretty drastic where we are right now. And of course, Eurozone recession is another potential risk. And I think the Eurozone will probably go into recession faster than the US. So it's something I'm really looking out for. And I believe the market has underpriced this. And because of that, I do want to maintain as much of, just want to hedge our bets as much as possible going forward. Okay. Second bold prediction is, showed this before, so I want to show it again. Second bold predictions, I think, if we go into a very tough recession and you go into elections, I think Trump is likely to win the elections. And this is really from a survey done by the New York Times. And it says that, they believe Trump will do a better job on the economy and, national security. And that's really the risk that's front and foremost for most Americans right now, because inflation's up, earnings potential, your ability to spend has gone down quite a bit. So that's an issue. And then if you talk about like geopolitical risk, right? Who do they think can handle it better? And the answer is Trump. Then you come to this place where you're like, okay, given the Israeli conflict, given where Russia was, do people like prefer Trump over Biden? I think the answer is going to be yes. How this will affect our portfolio, I don't know as of this moment. I would have to wait a bit and do a little bit more research on that. But I do believe that the probability of him winning is quite high. So over here you have the swings. These are the swing states, and you can see it's overwhelmingly Trump for most of these swing states. So yeah, again, it reinforces the belief that I think Trump might win. And yeah, with that, and Trump comes back into power, what does this mean for Chinese stocks? I think it might be interesting. I think if people are more comfortable with Chinese stocks or there's certain concessions to be made, we could see like a restoring of the difference between the Chinese stock market and the US stock market. I'll cover this a bit more later. But another concern I have, if you look at this Mag 7 stocks and the US stocks, there's a huge difference between the Mag 7. The Mag 7 is really just the Facebooks, Amazons, Apples, things like that, Nvidia, right? And these are trading at very, very large premiums to the rest of the market. So everybody believes that these companies will continue to grow and grow very fast, and therefore they demand a higher multiple or PE multiple. And this is generally the case when it comes to higher PE multiples. But what I don't believe people are suspecting is this can be a bit of a bubble. And I say that cautiously because I believe they're great companies. Like Amazon's a great company, Apple's a great company. But do you really need the new iPhone when you're struggling to pay your home mortgage? I don't think so. So in that case, savings rate will go down, right? And if that's the case, then is there any reason for you to expect very high growth from Apple? I don't think so. So again, these are just things that I don't know. And looking at the metrics is like, it's kind of risky. To me, it's kind of risky. So I won't touch the Max 7, especially going forward. I haven't touched it like in the last 3 years. So I've always thought it's overvalued, but it's gotten worse, right? So at these elevated levels, it's hard for me to justify purchasing any of these. And this is also one of the reasons why you would see I have underperformed a lot of the other PIs who are involved in your Amazon, your Apples, Facebook, things like that, because I don't generally like these stocks because of these valuation metrics. But yeah, we'll see. I'm still not interested in buying them, unfortunately. Okay, so here we go. So quick market update, and yeah, just some notable positions going into Q4 2024, 2023, sorry. The first is we're giving up on CRK. CRK is one of the positions I had as I was kind of expecting, net gas prices to go up, as all would go up, because net gas is still considered a green power source. But as you can see from CRK had Comstock Resource had the best EBITDA margins of the entire industry, so I did like them a lot. But having said that, what happened is we did expect all natural gas prices to recover, and they really haven't, and it's been a bit frustrating. One of the reasons is weather, so they're expecting a bit more warmer weather, so therefore they won't be using as much natural gas. Second reason is there's a huge price difference between natural gas in Europe and US, and that arbitrage is because there's no shipping facilities or not enough shipping facilities coming up. So Comstock Resources could benefit from this next year, but as of this year, it's not very clear to me that it's going to do well. So hence, because we're expecting recession and stuff like that, I decided risk off is better. And does it deserve to be our largest position in our portfolio? At this point of time, definitely not. So we scaled that back a lot. So I've halved the position from about 10% of the portfolio to about 5%. I might trim it a bit more depending on how we go, but I do see like their last earnings wasn't that great. Listen to investor call wasn't that upbeat. So yeah, I'm a bit more skeptical about CRK now, and therefore we'll reduce that position. So it didn't work out as how we hoped, but we didn't lose that much money. In fact, we gained like 1-2%, so that's fine. And yeah, we didn't lose. And yeah, one more thing. This is the concept which is kind of baffling, right? Like the reason why we do so much work into stocks is really because if things go wrong, it doesn't go so badly wrong. So in the case of CRK, we are very lucky, but also we did a lot of work. In the case that we were wrong about natural gas thesis, which we were wrong, we didn't lose that much money because it was the best stock in the sector. So probability of us losing that much money was low. So that's why we do this much work when it comes to our thesis and our ideas. Okay, so on to the next. Yeah, I'm gonna cover this. Next portion that I want to talk about is really our two other largest positions. So this is Danaos and Phinia. So unfortunately, these two stocks, it's going to be an interesting one because these will require a little bit more patience. Shipping and Danaos is one of those sectors that's not very loved, and it goes out of fashion very quickly. But we're quite confident of its cash flows, and as I'll show in a minute, we reviewed their earnings and they still look decent. Same thing with Phinia. I do love it. I think it's a great stock, and I'll go into reasons later, but I think it's a great stock. Reviewed its own earnings. But we're going to have some patience with these two. I don't know when it's going to come back into demand. I don't know if you guys recall last year, if some of you were copying me, we were talking great things about Wire and Home Builders, right? Or was it BLDR, Builders Resource? Things that we love about these companies. But when they took off, right, when they did really well, we didn't know why or when. It just kind of happened. The market just decided, hey, now's the time, so it just went. So all it required is just patience. I think this is going to be one of those same cases here. It's going to be, it's so undervalued, it's just going to require some patience. And if we hold out long enough, I think it'll do really well. That's why it's one of the largest positions. These are the two largest positions in our portfolio, and that's why they have to be updated, Okay, so yeah, we'll just have some patience with this. Danaos, this is the thesis revision. So it's a cash flow generating machine. There's minimal debt. It does have some, but not that much. Price book to ratio is very good. So meaning if the company were to sell everything it has, it will probably sell for more than its price. But there are a few reasons why this is, but we won't talk about that. High interest rates won't affect it because it has an average duration of its charters for about 3 to 4 years. That means it's lending out its fleet at about, and for average contracts about 3 to 4 years. And when we did the DCF or discounted cash flow, which is how we value stocks, it still had a really decent margin of safety. So that's kind of why I like this so much, right? So at minimum, I'm going to expect to get about 36% return, which I quite like. And even given very conservative estimates. So at minimum, if we don't make 20% from this, I don't think I'll sell it. I'll continue to hold it. At 36, then, we'll ask different questions. But in the meantime, I think this is really good stock to hold. Okay, so next on, I wanted to cover their earnings, I believe. Oh yeah, this is a discounted cash flow model, which we used. And yeah, you can see its fair value price is really, really good. Yeah, so they came up earnings recently, and it missed by, you can see here, revenue missed by a little bit in terms of EPS, but beat by revenue, top line revenue. So this is kind of in line with what we're expecting. Again, if you look at our discount cash flow model, we're not expecting much growth, but we are expecting a 20% return. So if our EPS is gone down by, like 1% or what have you, this doesn't really affect much because then we're expecting like 19% return because of the discount rate, right? So it's kind of fine. I don't think it's something to be terribly worried about. Listen to the earnings call, nothing much to report. I think it's quite okay. Phinia, it missed like 13 mil as well, so not by much. And this is one of those things that you find about all these companies that we buy. They tend to be smaller caps, so meaning they're not very well covered by analysts, and so commentary is quite thin. But I think we have more edge in these cases because nobody's looking at them, so they to me are a bit more interesting, and they tend to have a better risk-reward return ratio for these. So one of the things they said that is even though they missed, they are expecting the outlook for sales to revising its outlook from sales upwards. So typically when you have a bad quarter, right, you're going to revise this downwards, but they revised it upwards. So it's going to be net outlook sales another 60K, 60 million. And then here, they've adjusted sales as well, adjusted EBITDA. So what you're seeing is, they're doing really, really well. And yeah, it's baffling to me why this stock is selling so cheap. But again, there are many reasons behind that. I just love this stock. Okay, yeah, this is the reason why it's one of the largest in our portfolio. So these are the two reasons why I think the stock is not trading well. One is it's a special. So I quote this book a lot, right? So Joel Greenback wrote this great book. One of the things that he covers is special situations. Spin-offs, because spin-offs normally do badly after launch. One of the reasons because they're a smaller market cap, and investors are forced to sell. So in this case, what happened is that because PHIN was kind of divested from a bigger parent, some of the funds may not be able to hold on to its stock because it's smaller cap, so they were forced sellers. And forced sellers means that there's illogical price, right? If there are illogical sellers, it might be logic. It's just illogical price. So great time for us to buy. And second, they have great share buyback program, right? So they're gonna purchase 11% of its market cap. So even if the stock doesn't do terribly well, it should still at least produce 11% return because generally they are buying back. So this creates great return risk rewards metrics for us. Okay, and yeah, we can add more special situations. Normally, if you find one special situation, it's amazing, right? In the case of PHIN, you have 3 special situations all in the same stock. It's amazing. So for this, they have internal buying, which means that the people who run the company, they actually bought the stock. So these are the people who know the company the best. And if they are willing to put their own money into it, it tells you something, right? So that's the general thesis behind it. So yeah, they bought more stock, so that's great. And yeah, okay. And yeah, street valuations, I think we've covered that. So I did do a DCF on it. I think it was, margin of safety is going to be 27%. So I do expect at least 30% return from this, 30% return from the Danaos. So these are kind of drivers that I think will do well for a portfolio next year. So we'll see how we go, but that's generally how I see it. Yeah, and more DCF calculations. Okay, and every quarter I have to update on how well our dollar Swiss franc is doing because it has been a very long trade. I've been holding it for a very long time. And every quarter update, sometimes it's good, sometimes it's bad. I'm happy to report it's decent, So we continue to hold it because I think the thesis still holds true. I don't think the Eurozone is going to continue to do as well as the US economy. I think the euro will suffer first, so euro prices will go down, and therefore I think Swiss franc should follow as well because they tend to be quite correlated. But yeah, this should show you the metrics. What happened is that when we put the bet on on a leave it basis, we're getting about 18% in terms of refunds on the carry trade. So this means if we just hold the position and do nothing, we should get about 18% return. And yeah, so this is kind of how we're doing a mean reverting strategy. It means that, we don't think it will move in a straight line. It will just kind of revert back. And we have a technical analysis overlay over that. And yeah, I've covered this. I think that the US is expected to do slightly better in terms of its GDP growth as compared to Switzerland. Switzerland's not expected to do so well. And, they always talk about like how the US is overperforming the EU. So there are like factors that, contribute to, if we go into recession, EU will probably not do as well as the US. Okay, and what happened is that, the last time we showed this chart, we did really badly because we bought in about this like 92 handle and it dropped all the way to 85 and we were down a lot. Happy to report we are only negative 0.57 right now. So including the closed positions that we have and the refunds, which is just the interest that we have, and the Euro US dollar positions that we used to hedge it, we actually made back quite a bit. And again, these are accurate as of, I think, a couple of days ago. P&L is still negative on the current positions, but because of the refunds and all that, we do have only a slight down position. So very, very minor. But again, because I believe in this thesis, I believe that there's no harm in just holding the position. This should still contribute to our current portfolio, and it's uncorrelated to the rest of the bets that we have, because Danaos is of course shipping, PHIN is really internal combustion engines, there's like parts for that, and currency is just totally unrelated, right? And in a recession, US dollar should do well. So this uncorrelated bets, hedging our portfolio, plus we get interest. It's great for our portfolio. Okay, and yeah, if you want to see refunds, what you need to do is just go to your positions and just click on it. And you can see these refunds right now. These are just positions accurate as of my portfolio. Okay, and on to China. I mentioned I would cover this later. Yeah, I said just now, it's general fact, PE ratios are higher in higher growth stocks because you're expecting the higher growth to catch up earnings. And essentially what you're saying in this entire thing is you think Germany is growing at the same rate as China, which is clearly not true. You can see here, Germany is like minus 0.1 and China's 5.5. You can see even against the US, China should trade at a higher PE ratio because it is growing faster, but you can see here it's not. It's just not. It's like half the valuations. And again, there are many reasons for this. Media bias is definitely one of them. Lack of stimulus coming out of China is definitely one of them. But I think these things will recover next year, and that's just my view. Okay, so here we go. Yeah, so I do want to talk about 3323, which is our biggest Chinese holding companies. And we said that, at $4.12, this was a great buy. And guess what happened? Like, it dropped some more. So now it's $3.70, right? So we said it was cheap. We said it was great at these prices, and then they continue to drop. That's just reality of the market, guys. It happens. So what we've done is we've bought 0386, which is our Chinese Sinopac, to kind of hedge the positions. Again, this is just showing you the valuations used for 0386, and I covered this in the last call, so you can go have a look at it if you want. But yeah, I do think this is a great stock. I do think the valuations are decent, and I do think we will do well on this. And again, if you look at my growth rate, it's like -5 basically forever, which is not likely to happen because China is growing. It is the construction sector which is a bit scary, and that's one of the reasons why the valuations are so depressed. But again, I do believe if you're coming out of a lockdown situations, are they going to be better or worse than going forward? I think the stimulus will eventually come over and help this along. 0386 is going to be hedged on our portfolio. Again, this is just a Chinese oil company. It's basically like the Chevron of China. If you want to look at it that way, they do a lot of different things, and they're owned by the state government, meaning that probability of them failing is quite low because government owned. And yeah, it's great valuation. So again, I covered this at the last call. You can go look at that if you want. And yeah, I think fiscal some kind of stimulus is coming to China, and whether that's infrastructure projects or just monetary supply, something's going to come, and that should help our stocks kind of grow. Oh, and the last one I wanted to cover is this has really taken up like most of my time recently because it's such a fascinating thing, right? We've done so well this year on basically trades that involve merger arbitrage, just so well. And two of these are BKI, which is Black Knight, and the other was Simo. So these are two that really contributed to our returns this year. And yeah, you can see we also bought like NDB, NMTM, which is the nano dimensions, and this is also special situations, and GLE, which is also a special situation. So this is a Society General, and yeah, we bought these all because of special situations, and it's done very well for our portfolio here. And for this is very interesting because this is JetBlue acquiring Save, which is another airline company, and airlines are doing terribly. Fundamentally, I would never touch the stock. Like if you look at valuations, I would never touch the stock, and that's kind of why I don't size this up like too much. But looking at the court case and the documents, I do think that there's a high probability that it's going to get acquired at $31. And it's kind of trading at 13 right now. So you're looking at more than double our money, right? So right now it's about 3% of our portfolio if we account out for all this. So 3% of portfolio, chances of us doubling our money or double in a little bit is quite high. So that's like another 3%. But if it fails, we lose about 50%. So this is like very high risk, right? So you could lose 50% of 3% means you lose 1.5. But if it goes well, you make 3. So I don't size this up that much because the risk are much higher. But if it does well for us, we do well. So this is great. Yeah, I'm still watching this really closely, and I hope it'll do well for us. I'm not sure if I want to go through this, but basically, what we did is we looked at the court documents, and we said that, okay, look, these are the reasons why the DOJ wants to block it. I think there's been significant moves to try and mitigate that. And we talked about risk reward. I think that you can't just back out of a deal also because you got it at a bad price, by the way. You can ask Elon Musk about that when he bought Twitter, right? Like he promised this price, it dropped so much, but he still had to honor this price. It's just how the markets work and how mergers work. So this one is really interesting because I don't think they can get out of it. I don't think they want to because they spent basically 2 years trying to figure this out. And for them, it's the best way to grow. So I think JetBlue will continue to acquire them. So I think financials have probably been secured for this. Yeah, and I don't think most merger arbitrage desks are looking at this. And again, I got this from kind of a chat group I'm in, which I quite like. And yeah, they prefer safer returns. Save, it's a bit riskier for them. But looking at it, I do love this trade. It's kind of interesting. Last one I want to cover is I want to end on a high note. I think we've done really well in GBTC. We bought it when it was like 30% discount, and now it's 10% discount. So this is another example of one of those trades we've done like a lot of homework. We said that we want exposure to crypto, but I don't like crypto that much at those prices because it was kind of the in between. So what we did is we sized up on GBTC because we said, look, if crypto goes up, GBTC will benefit. And if the FTC continues to regulate or SEC continues to regulate it, and I don't think they will, the discount will close. So we did very well on that because Bitcoin has gone up, and doesn't looks like the ETF is going to be approved. Looks like, we don't know. And yeah, that's been doing really well for us. So it's doing really well. Once the SEC kind of figures that out, and then we'll probably exit the position and maybe switch to something else. And I think I will start trimming as well because I'm a little bit worried about crypto valuations at the current moment. It may be good, it may be bad, I don't know. I think the ETF is going to be great. I think having to buy that much Bitcoin off the open market is going to be very difficult. So I think that the price of Bitcoin will go up. But again, it's just about risk sizing right now. I think we have quite a bit of risk. It is nearly 8% of our portfolio at the current moment. So it's a bit high in the portfolio. But yeah, once this closes, we'll see, and then we'll monitor from there. So yeah, actually that's all I had for this call. It took about 30 minutes, so unfortunately not as short as I hope, but usual. Again, any questions at all, guys, please feel free to just leave on my wall. Not really on YouTube because it's harder to monitor the comments there, but if you could just post them on my wall, I'll try and respond to them as soon as possible. And have a good one. I'll see you guys in 3 months, and we'll have hopefully a great end of the year. And wishing you all the best. Happy Christmas. Happy New Year.